Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, so here we are. We've got a relatively flattened skew. I mean, if I want to go even lower, I can actually get a really cheap bet. Look at this. I can pay 35 cents, buy and sell kind of the same skew, and when this thing drops the next day, I'm going to be in really good shape. So now you can see I obviously do have a negative delta. I'm going to go in and fix a couple of things because this is sometimes the settings that I put in here disappear for some reason, unfortunately. And this is one of those cases. All right, okay, and then model, none. You can't use the Yates model. None, standard model. Volatility settings today. Well, there you go. There is the hoops I jumped through for you people in order to get the proper price in there. All right. So now we have these volatility skews. So let's just say I throw on a put spread and I buy the the 106. You can see you can buy the 106 105 for the same ball. You can buy the 104.5, and you can put on a 50-cent spread for a nickel because the skew's kind of steep. And look at kind of the spread between 105 and 104, and then look at the spread between 104 and 104.5 and 104. You get one spread that costs 15 cents and one spread that costs a nickel. All right, that's actually volatility skew coming to your advantage. When this thing falls, you can turn a nickel, theoretically, into a 50 cents, a quarter, something along those lines, very quickly. It's actually a really nice way to do business. So let's just say we just throw on a real quick, cheap, little 35-cent put spread. Convert the trade, and then obviously, I've gone back and we've looked. The dollar falls off pretty quick, and you can see the 106s gained IV. The 105s actually lost implied volatility. And yes, there was a little movement of shift along where they were along the skew curve, but we made some pretty decent cash real quickly overnight on a very cheap bet. And that's something we really like to see when we're trading is cheap bets pay off. All right? And if you can take advantage of volatility skew, all right, you can turn a cheap bet into a winner pretty quickly. All right? And notice that 104.5, now we're in great shape. Notice that 104.5, 104 spread that we're looking at that we could have bought for a nickel is now 30 cents. And this spread that we put on for 35 cents is 85. So we did 75. So we did reasonably well. I'm not going to sit here and complain about that spread. And the reason why we ended up putting on that spread was because the skew shifted in our favor. All right, and I believe I pushed this one back to. I want to double check and make sure I put this where it's supposed to belong. Nope, that is the right spread. Okay, so let's kind of take a look at, where are we? Let's take a look at, sorry, I didn't mean to get out of place. So let's take a look at September 15th in the Canadian dollar and see what was happening then. All right, so we're going to roll up to September 15. And obviously we're going to be using the October contract. And watch kind of how the October contract has moved. And if you pay attention, it actually is, the vols are steepening on this thing just slightly, and they're getting more and more and more steep. Okay? So here we are on the 15th, and what do you think? I mean, I didn't see what ended up happening today, but I know that in a short period of time, by buying, all right, this time we're going to go with the spread the other way. If we buy, and you can see the calls here, right? Look at the way the skew is kind of shifted up. We could buy the 104 and put on the 105 spread, and put on a basically at the money call spread that was right there. That we want to go up to the 15th, and we don't want to use September. Apologize, folks. All right, so here we go, and you can see that we've got the skew. The skew on this trade on where we are is pretty steep. All right, certainly steepened up. And let's say we want to get long, we can buy the 104, 103 spread for 35 cents. Okay, we're paying 120, and we're selling at 85. Now, I looked, and plus or minus a day, you're paying 40 to 45 cents on that spread. And relative to where the price is, okay, price adjusted. And again, that's that case where that nickel matters, all right? If you can get that nickel, that trade is in so much better position to win, okay? And, I know that this kind of goes in our favor, so I believe. If not, then I'm going to be eating some crow here. All right, yeah, you can see, we're picking up a little bit of here we go. Yeah, so let's take a look at what happened here. We actually have a position where our spread really isn't working very well, right? It's up about, what, 30 cents, okay? What has happened to the value of my spread? All right, I believe I put it on for 35, and now it's worth 40. So with skew, using the skew, we've actually picked up a nickel, and getting in at the right time can allow us to be wrong for a little longer before we start kind of taking pain. And that's kind of an example for even when you're not winning, you can set yourself up not to lose. All right? Half of being successful as an option trader is winning when you can and not losing the rest of the time. If that makes any sense.
Point, Mark. That is an absolutely great point. I mean, I think that what you just went through over the last 5 or 10 minutes is so important for traders to understand. Thank you.
Mm-hmm. Well, you're welcome, and it's something I really kind of concentrate on is that, it's really, not losing is as important as winning, all right? All right.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.